Hello, hello, hello. Good evening, everyone. Good evening. Welcome to the webinar about building and trading the system and how to strive for good trades in the market and how to read the market sentiment and how to trade uh, basically the markets in general and with confidence. Today we're going to be talking about what exactly is the system and why it's important. And it's essentially the system is understanding what makes the market move, um, how you gain an edge. I mean, nobody likes to trade blind. I don't know anyone who wants to look at a chart and just flip a coin and say we're going to buy or sell this, right? That's not really how you do it. So you got to know how to read a chart. You got to be able to understand what's actually happening in the chart, and not just go by hope, and not just go with the concept of what if this happens. No, you want to trade with confidence. You want to trade knowing that you're putting your money somewhere where it's not just going to disappear. And then you have to understand why the market's trading the way it is. So you have to understand the depth. You have to understand the action and what actually is happening in the market. The other thing about it is taking steps to ensure your survival. You have to understand how to survive in volatile markets. I'm sure people understand. People who have been trading for years have been trading in this market, and it's been hellish this year. This is probably one of the hardest years we've had in the markets since the early 2000s. I would actually say mid to late 2000s actually, because we had a phenomenal early to mid 2000 up until that little bubble. Uh, and then the idea is how you're going to trade based on back-tested strategies, based on market conditions that are presented to you on a daily basis. You're not trying to trade blindly. You're not trying to take guesses. You want to trade knowing full well where your money's going and what the chances of your success are. Uh, the other thing is mastering your emotion and managing your fragility uh, in this market. The idea is that a lot of people like to trade 100%, go all the fuck in, and that's not really how you're supposed to trade. It doesn't really work that way. Uh, Conceptually, you need to be able to trade uh, with a smaller portion of your account. That way, should something happen, it's not going to go to hell, so to speak. So you have to be able to deal with that. Uh, So the only way to actually deal with that, and I'll go over this later, is with position sizing and understanding that 1% of your account can very easily become 20% of your account or 10% of your account, just like 1% of your account can become 0% of your account, just as 100% of your account can very easily become 0% of your account, especially in the options market. And that is why we deal with this. Uh, so understanding your risk profile and your position sizing is probably the biggest lesson you could learn in the markets today. Uh, Tons of people they go on Wall Street Bets, they go on all these channels, and they go through all these gurus, and these guys give you really bad advice. They tell you they see SPX, they see the wild all-time range swings that it has. I mean, think about it. SPX moves 20 points, 30 points, 40 points in a day this year. Meanwhile, I want to point out that for years SPX has moved maybe 5, 6, 7 points over the course of a few months. Meanwhile, we're getting that kind of volatility all within a day's time now within these markets. So you don't want to be, Jimmy FOMO YOLO trader who goes 50% in on SPX dailies on Wednesday for 50 cents because they look cheap, and they go to zero. I mean, don't be wrong. They work out once in a while. Your 50 cents can very easily go to $5, but more likely than not, it goes to zero, especially if you're just wildly trading. It's not really how you're supposed to do it. So, once in a while it works out, and emotions get the best of you. This is something I see a lot in traders. This happens is very, very often in traders, right? So this is very, very often happens, and they get good trades, and they think that the world is theirs. They think that they're unstoppable. Next trade, there's going to be even better. But the trade before that was a problem because they just made 100% on a trade yesterday, and they only went 20, 30%, uh, you know, of their portfolio size, and they're like, what the fuck, you know? So, you know, and then once in a while the market crashes 3%. SPX goes from 29.30 to 29.03, and Jimmy loses 80% of his account overnight. I've seen this happen firsthand. Jimmy's very, very sad. You don't want to be Jimmy. You don't want to do that. So that's something you don't want to do. But you can be like Johnny, you know? He has a small stable of tickers. He doesn't just follow the news. He doesn't just buy Tilray at $300 because Tilray seems like a good idea at $300. Okay? He doesn't do that. You know, he plays BA, he plays Google, he plays Amazon, and he understands the charts, he understands what makes them work, and he plays them. He plays them good. He watches ES, he watches all the breath takers, he watches the trend, he watches the McClellan oscillator. He watches all of these indicators to let him know where the market wants to go next. And he reads in between the lines. Like he understands, the possible deals coming out through Donald Trump, through his orangeness. He understands all the possibilities that are there as long as he can read through the markets. So that is something Johnny does. He understands that because these markets move a certain way, he understands that he could take a 4% position size in something, and based on this 4% position size, that can become 20% of his portfolio. And when 4% becomes 20% of your portfolio, that's a nice payday. You don't need to go crazy. You just need to have these trades, right? And the idea is that you trust the system that you've built. You take these buys that when the market's in these perfect conditions, right? And you take the sells when the market's too damn high. And when the market's too damn high, you go on vacation. You go to Vegas. You go to some beach somewhere. And you go enjoy yourself because that's what you can do after you've done a good run. So this is something that we have to deal with, right? We have to deal with these two kinds of aspects of us inside because there's a little bit of Jimmy in me too. I like to gamble as well, but because I understand the pros of being Johnny, I'm just going to keep watching my positions. I'm going to keep watching the tickers I know, and that's what I'm going to trade based on the breadth indicators that I know and love, and that's what makes me money. So the other thing is about charting, right? So you got to understand, like, backtesting matters. You got to understand what all these charts mean. I'm sure you've seen all these different indicators a million times over. The bullish pennant, the triple bottom, the heads and shoulders. You see these all the time. And the thing is, do you actually know? Do you actually know what the rate of success is? Because honestly, I don't know the rate of success on these tickers. I'm sorry, on these formations. I don't know the rate of success when I see these candle bars line up in this way. So I'm not going to trust it, right? So that's the idea here, right? You can't just trust every single, triangle and every single wedge. You gotta essentially trust what you know is back tested, right? So what we did was we back tested a couple of these on a few tickers. And when I mean a few tickers, I'm talking about the entirety of the NASDAQ and the entirety of the S&P. So we have the inverted head and shoulders, right? Now, if you were to guess how often this works, you would think it works quite often, or you would think, like me at first, that this is just another clever ploy for people to lose their money because, people want to actually, people like the market makers actually want to take your money, right? So they can essentially mechanically create these kind of patterns with big money, right? But then you learn that this actually works 79% of the time on the entirety of the S&P and the NASDAQ. Okay, then you got the head and shoulders formation. Now, this one, here's the problem, guys. I don't know if you've noticed this. We actually held through a head and shoulders, and we actually cut our GS when the shoulder fully played out, the right shoulder fully played out. So if you take a look at that, right, we kind of saw a head and shoulders in GS, and we said, screw it, because there's an 81% chance that it was going to fall further. And that's exactly what happened, okay? But then you got other ones that we see all the time in the market, right? You see these all the time and you think that this is going to be the one, right? You think, I'm going to buy in at these levels and it's going to move up, right? But you don't know because you didn't back test it, right? What are the actual chances of this actually working? Only 56% of the time. Might as well flip a coin, right? Doesn't really work that much. So you see these kind of formations happen all the time, and you got to question whether they actually work. Okay, and then the bull flag, everyone's favorite bull flag. We see this thing and it's like, no, it's flagging, it's flagging. We got to keep buying, right? Well, you're buying and I don't know if you noticed, but the channel keeps going down. This channel just keeps moving down. It's quite awful, actually. All right, so why would you want to buy into that with only a 60% success rate? A 60% success rate for that's terrible, right? For the chance, a possible chance, I wouldn't take it, right? So we look for these sort of patterns, and we have to understand why these patterns matter, and that's because we want a high rate of return. We want a low risk trade. So when we see a pattern like the inverted head and shoulders, right, or like the head and shoulders, we definitely need to take positions in those. Okay, it's just it is the way it is, and it's not about chasing or guessing which direction it's going to go, but it's about capturing the moves. So next we go into what happens with these, right? So essentially we have to see where the auction starts, right? And this is going to be a chart of Amazon to show you the trading psychology behind the candle combos that you saw before. Okay, you've seen the bull pennant, you've seen the the bull flags, you've seen all these candles appear before you before, right? But why do they happen, right? What is the reason for this, right? So you essentially have Amazon here, and these charts of Amazon show you kind of a maldeformed doji that's moving to the upside and then a gap up, right? Followed by yet another doji, right? But this here, what interests me more so is this action right here, okay? This buying up of the bottom of the aggressor channel, and why does that happen, okay? So the conceptually is, in the next chart we have here, you have the bottom here of the channel, and you see how it lines up with essentially right above the 0% line. But where the candle actually floats is where this gap gets filled, right? So essentially what we had was a gap being filled here, and once the gap was filled, we had enormous amounts of buying. So the auction started, right? The auction started. And the auction started, and they bid up the price to the bottom of the regressor channel and to the bottom of the trend line that was formed about a month ago, okay? And that moves into the market profile, showing us all the gap, okay? Now, this is what's more interesting to me, okay? Because this shows us basically the weakest of the weak hands, right? These are the people who literally thought, it's going down. It's going down even more. And there's nothing I can do about it. So I'm going to sell my shares here, right? And you have this little bits of volume here. But then someone realized they made a mistake and they started bidding it up and bidding up. And then by the time you actually had decent volume actually coming in, where people were actually buying the shares up, right? It was already closer towards the bottom of the trend that is displayed here. Okay, so these charts essentially show us. Uh, so these charts essentially show us the renewed faith and zeal in the underlying, showing us that buyers are willing to pick up the price after the weak hands had just dropped their shares, and those are the weakest of the weak hands, right? Just like these up here on the buying are the weakest of the weak buyers. They bought the very, very top of the dip, and they were literally saved by more buying. Okay, so conceptually, those were the chasers at the very end of the day, based on this market profile, and they bought it at the very, very top. So this shows us where the weakest hands are in the price action, as well as where the strongest hands are in the price action. And it's very, very important to understand this because it makes you understand the actual trading psychology taking place within the markets. And it's important to understand why people buy and sell at these points, and why for that moment, that 5 minutes where all this volatility happens, where they literally think the world is coming to an end, why they're selling there. But we don't care why they're selling there. All we want are their cheap shares. So that brings us to the stopped momentum candle, aka the chopped cheese. Okay, this is one of my favorite things because this goes with my 10-second rule. This goes with my 10-minute rule of the day, which means that you end up picking positions at the very end of the day. Now you're going to be asking me, what the hell is a chopped cheese? Well, it's, come on, it's the chopped cheese. It's the legend. It's the legend of New York. You know, you can't just screw around with chopped cheese, right? It's the best. Okay. So we love the chopped cheese, and I'm gonna explain to you a chopped cheese, a more recent chopped cheese that happened very, very recently. Okay. So we have here a chopped cheese on all three indices. Okay. We have a chopped cheese on the Dow, right? This long wick that that engulfs the previous day, showing us the 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 overzealous buying to stop momentum from going down further, right? And then the slight amount of selling that happens at the very top. Okay, and this forms a near doji and gives us a little bit of green, which I like to call the meat, right? So we have this bun followed by meat. And what usually comes after the chopped cheese is, after the meat of the chopped cheese, is the bun that goes on top, which is usually a gap up. It usually gaps up the day after. And this is a strategy that we use in the channel very much and very often because it works. Essentially, when you find the possibility of these things happening, you can easily take a contract one day, sell it the morning of the next, see if we can get a bounce towards the end of the day and pick it back up right at the very end of the day for the gap up the next day. It's the easiest way to play an option in some cases. Uh, it's the easiest way to actually deal with the momentum that you can actually get. And it's a low risk trade overall because the idea is that once you sell out, the next day the premium should be rushing out and you can definitely pick it up for cheaper. If not, well, luckily for you, you have a gap up the next day and you're not really missing much. So this is what we call understanding the charts and understanding the strategies that we use in these particular tickers to make us money. And it's important to understand this because if you don't understand the chop cheese, you're not going to be able to make money understanding that strategy, right? I mean, you have to understand why the chop cheese happened, right? And understand why the gap was there in the first place from the chop cheese, right? Then you have to understand the ET strategy. This is one of my favorite ones. We call it the setup strategy, SET strategy. Sometimes we put the picture of MJ and ET up together to give you an idea of the 8-day moving to the 21-day, and it works. The strategy works. It's great. You see it in BA all the time. If you pull up a more recent chart of BA, which we might do after, you'll see how BA easily moved over that. If you notice here on this particular chart, this is an ET when BA was 341 on the price target, right? And now it is 370. So the idea is that. And next is the mirror box strategy that we get in SPX. And as you see, this is when the price of SPX was 28.72, where we had a possible move to the 100%. I'm sorry, this was when it was 28.60s. We had a possible move to the 100% at 28.72, which we clearly shot over. And I believe we're now sitting at the 116 mark on SPX around 29.30s, right? And the future should be moving up as well if we do have a chopped cheese coming in from today I'm sorry, if we have a chopped cheese coming in from Friday into Monday. So understanding the setup system, understanding the 6-8-21, where the price action moves to the 6-day and the price action closes above or below the 8-day depending on bias, because the setup system works on the upside and the downside. It can move if the 21-day is below the 8-day. You better believe the price action will move towards the 21-day. Then, if the price action moves towards 21-day, and that is the completion of the ET or the setup. Next, we have a section which we call where the money's hiding, which is where the blocks are being bought, and where Tesla, for instance, was on Friday, and how those blocks towards the end of the day were all long puts, right? So the idea was that towards the end of the day, there were a ton of blocks on Tesla showing us that they went long puts, right? So we have to understand what is behind this flow. Was this someone buying or selling these calls? I'm sorry, was it someone buying or selling these puts? Right? We have to understand why and who. Well, not really who, but why. Then it's an older flow that we have where AMD was actually strike price of 21, and where we had a big buyer actually buying into sweeping up about $250,000 worth of AMD calls when the strike of AMD was 1905, and they bought up all the 21 calls for October, right? In other words, someone had the foresight to understand that had they held their 21 calls into October, they would be shit out of luck and they would have lost all their money, right? And you take a look at the price of AMD today, what is it? In the 30s, right? So you look at these sweeps and you try to get an idea of where the sweeps want to bring you, right? And then you get an idea of what is going on with those sweeps, because this is the only way you can get a real idea of where the market wants to take a certain ticker. So next is the time cycle edge, I like to call. So what we have are essentially uh, the internals and a picture of some of our tickers that we play, right, with some signals. Now, the idea is you have to understand what these signals are, what it all means, and what they are in relation to the TRIN, put-call ratio, the VIX, uh, and how they affect the indices and the underlines, and why they matter. For instance, in this particular image, we see CMG entering a time cycle 1. I'm sorry, that's CVS entering a time cycle 1 at price action of $73. Now, a time cycle 1 is essentially a continuation of the trend to, in this case, the upside. And when a ticker enters time cycle 1, essentially there is a 68% chance of a continued move to the upside. Now, understanding this is not enough, okay? Because you have to understand why these things move. So we use these time cycles in conjunction with looking at other indices. We look at them sector ETFs to understand where each sector wants to go and understand where there is a possible rotation. For instance, when the Dow is entering time cycle 1 on a 7-day algorithm, okay, essentially what that means is uh, it's in for 7 days, it's going to continue the trend of whatever trend line it's going in, right? And generally, a 7-day algorithm means it's going to be a bigger move. For instance, there are 1 month, 7-day, 4-day, 3-day algorithms. Basically, whatever the our algorithm software allows us, that's what we can scan for. And we get a really, really good idea of where and when these particular rotations can come in and out of sectors. For instance, financials, tech, and industrials have all been performing pretty much close to the time cycle system, with XLF being in time cycle 3, and financials making a move down, and industrials making a move down towards the end of the week last week, uh, due to time cycle 3 going into time cycle 4. And then we had NQ actually misfiring to the upside multiple times, giving us an impression that the NASDAQ should make a run. And if you take a look at what happened at the end of last week, the NASDAQ was trying to make a run, and it ended up basically doing what we call the chop cheese that I explained earlier in the webinar, and it made that move. And it's all thanks to the time cycles, and the time cycles guiding us in which direction the tickers want to move. So this comes down to having trust in the data, trust in, oh, and it's just been brought to my attention that the NQ has just entered a position to buy. So the algorithms are still long NQ as of this webinar. So the next thing comes to trusting the data, trusting the data and the news enough to have confidence in your trades. So we had beginning of the massive bull run last month. We had at 11 a.m. notification of possible news events alerted to us by the trend on a shorter time frame and social sentiment. At 11:17, there was positive Turkey pastor news. You remember the whole pastor geopolitical tension that brought down that kept bringing down the lira? Well, that was circulation of that, and that brought up the lira. At that point, we alerted to a couple of trades. First trade we alerted to at 11:20 a.m. was the get into SPX 2850 calls, right? They were 65 cents. Cheap, cheap, cheap. But they were really, really high risk. But we trusted data enough to go with the news, to go with this trade. And that, after about, I don't know, 16 minutes? Yeah, 16 minutes. I closed my calls for 40% because I thought 40% is a good enough return for 16 minutes. But no, it wasn't, because by 2:20 p.m., they were over 1,000% gain. Okay? And that is what happens when you trust the indicators and the algos, and you are rewarded for it. When you properly speculate on news that is kind of being flashed in and out for you by algorithms, it makes sense. You have to take the trades. It's silly not to. So we take risk based on proper data, and we're rewarded for it, right? So there you go. You have this indicator, this perfect indicator of when we got into SPX. We trusted that perfect indicator, and we did it. You know, we just followed it. And that brings us to the next step, which is after you get a huge goddamn run, a huge bull run, right? You gotta take a step back. And you know these bull runs don't last forever, so you gotta short the market. Because if you don't short the market, you're just asking to what, stay long, and what, you're gonna just let your money be taken away? No. So we take puts. We short the market. We need to have our money, right? We have to play. We have to be able to be nimble and play both sides. And that is what happens when you play both sides. You're able to take the longs. You're able to take the shorts. You're able to make money both ways. And when you play with proper position sizing, you know, 210% on a 4% position size means that your 4% position went to around 13, 14%. I mean, you gotta. It's ridiculous not to take those kind of profits, and it's even more ridiculous to put yourself inside of a headspace where that all that money can be gone overnight. So you don't want to go heavy, and this is what we keep saying: position size. Which brings us to our next step, and this is what we're doing next month. We have an ER run, gentlemen. We have an ER run. Okay. Now, essentially, this is what an ER run is. Okay. So an ER run has a couple of points, right? The official start of the ER run starts with JPM. JPM earnings on the 12th of October, okay? Now, JPM earnings, 12th of October, is usually when things get really, really fun and Ivy starts really rushing into contracts, and your Delta 3 contracts that usually go worthless overnight on a 1% move will now be treated like Delta 1 contracts, and they won't really lose their value, right? It's great. It's amazing. So the next step is to find the right stable of tickers to trade to maximize our ER season moves. We have to be able to make money. We have to be able to do it safely. We don't want to go all in on some crazy biotech pharmaceutical, which is going to take away all our money in 20 minutes. No, we don't like that shit, right? What we like is a ticker like BA, which will consolidate for a week or two and then decide to make a move. And in that week or two of consolidation, we've already made money on the IV gains. We don't care. Okay? Just to give you an idea of one of the IV gainers we had that really, really worked out for us, right? We had Netflix ER at the beginning. I'm sorry, not the beginning. We had Netflix ER about a week and a half ago. We officially started our first tranche on Netflix ER. Now, generally, my ER plays, if I get 30 to 40% on them, I'm very, very happy, right? But overnight, we had 100% on Netflix. It was silly not to take those profits. And that's what we did. We took those profits. Don't get me wrong. Maybe if I held them, I would make more money. But I'd rather have the safe money rather than scratch my head wondering whether my 4% position, which is now an 8% position, whether or not it's going to go to 0% overnight. Okay, and that's not what I want. Okay, so ER seasonality usually dictates a lot of upward movement. So we don't really take puts unless we really, really hate a company. Unless the market really hates a company. It's just the way it is. And that's how you gotta trade it. Okay, so the average return on an ER position is roughly around 30 to 60%. I put 30% just on the low end because that's just how it is. And we don't really want to go crazy with the swings. We might take 2 to 3 positions a week. We're gonna sell those positions when they're up, and on the next tranches we'll take them. If we want to scalp around our core positions, we can always scalp around our core positions. Okay. Now the idea is that our guys, on my staff, we have a lot of monitors. We track. You hear it in the market commentary all the time and all day long. We have an EC to the upside. We have an EC to the downside on this ticker. BA is doing this. Tesla is doing that. And essentially, what we're looking at is something that looks like that. And we have a lot of our own custom indicators, right? And as part of our custom indicators, we are giving out a free workspace, we're giving out a free workspace which has some of our indicators and some of the stuff that we use on a daily basis, as well as the setup system already predefined for you guys in a nice window so you can already begin to trade using that particular strategy. And we are giving that out to you guys for free just because we love you. And the concept behind this is that this is a tool for the future of your trading. This is a tool for you to understand how to trade with confidence, to trade with a strategy that actually works, and to trade with strategies that are actually back tested. Okay? Because no one likes to go into a trade blind. I've said this multiple times. So every day we provide commentary and we do streams 1 to 2 times a week. October has been slow because, as some of the folks know, there's a lot going on right now. And I'm sorry, September has been slow because there's been a lot going on right now. And September really is a shit month for stocks. Everyone understands that you don't trade in a shit tape. Any contract you could take at the beginning of the month will go to zero if you don't play it correctly and you don't play it close to the heart. So that's something you got to really consider. So my position sizing all throughout September has been like a 1% position size here, 1% position size here, and I haven't really been trading in September because of this really, really terrible tape. However, we have October coming up, and October is one of my favorite months because in October we have ERs, and ERs, things just go up, and that's what we want. We want things to just keep going up. So why should you trust the system, right? The only way to get ahead in life, to get ahead in the market, is with a back-tested system, okay? We back-tested our system. We know what we're doing. We have a greater probability of success because we back-tested our system, okay? Even if we have a 1% edge, even if our chance of success is 1% more than the 50% of flipping a coin, it's still a 1% edge. And that's still an edge that we need in order to be able to make money. Okay. Now, on the right and on the left, you have two different types of algorithms. Okay. On the left, you have a long only seasonal algorithm that only works in the wintertime. Okay. And on the right, you have my Tesla algorithm. Okay. So these are some of the algorithms that we utilize in our day-to-day in order to help us trade. Okay. In order to trade and make proper decisions that are better than guessing, you have to trust the robots because no robot is going to essentially trade badly on purpose. It's not going to be a guess. There are so many predefined uh, scenarios and so many predefined variables that have to be hit in order for this algorithm to enter a position and tell us to go in. To give you an idea, we had an algorithm tell us Tesla to go short at 300 a week ago. It's up in our free alerts. Anyone can take a look in the Discord, right? If you had taken that alert, knowing that our algorithm is a 10-day algorithm on Tesla, and you held that position for at least 10 days waiting for this thing to happen, you would have made so much money, right? So you have to trust these algorithms. You have to. And that is why we do what we do. So we hope that you enjoyed the webinar. I hope that you enjoyed me yelling at the microphone for this 45-minute period. And I hope that you can join us today. Hope that you can join us and build a better future for yourself, for me. Because believe me, I'm selfish too. I want money too. And we all want to make more money, right? So the only way you're going to do that is by building the system and trading a system that is back tested, that can work for you. Thank you very much. And I hope you enjoyed the webinar.